When examining why Iraq's currency remains stable despite ongoing market pressure, the explanation begins with policy structure, reserve capacity, and deliberate exchange rate management, not speculation. The official exchange rate continues to be set at 1,300 Iraqi dinars per US dollar, and this rate remains the foundation for government budgeting, public sector salaries, import pricing, and fiscal planning. Maintaining this benchmark during periods of elevated pressure is not accidental. It reflects a conscious decision by Iraqi monetary authorities to prioritize stability over reactive adjustment. At the same time, parallel market rates have traded higher, often fluctuating between 1,420 and 1,480 IQD per dollar, depending on liquidity conditions, dollar access, and enforcement intensity. This gap is frequently misinterpreted as weakness, but from a policy standpoint, it functions as a pressure indicator rather than a trigger for devaluation. What matters to investors is that the official rate has not moved in response to short-term stress, signaling confidence in the system's capacity to manage demand without redefining the framework. A critical factor supporting this stability is Iraq's oil-driven dollar inflow. Iraq consistently exports more than 3 million barrels of crude oil per day, generating substantial foreign currency revenue that flows into state accounts. These dollar inflows support foreign currency reserves and provide the central bank with the ability to supply dollars to the domestic market when needed. As long as export revenues remain steady and reserves cover multiple months of imports, authorities retain the flexibility to defend the official exchange rate without exhausting financial buffers. Investors closely track this relationship, because a managed exchange rate is only credible if it is backed by real earning capacity, not borrowing or short-term intervention. Current data indicates that Iraq's reserve position remains sufficient to sustain its policy stance even when market sentiment becomes uneven. Inflation control also plays a central role in explaining why stability is being preserved. A sudden adjustment to the official rate would immediately raise the cost of imports, fuel price pressures, and strain household purchasing power in an economy that relies heavily on imported goods. By keeping the official rate fixed at 1,300, policymakers reduce the risk of imported inflation and protect fiscal predictability. This approach reflects an understanding that currency shocks often create broader economic and social instability, which can ultimately undermine confidence more than temporary market spreads. Finally, Iraq's response to pressure has focused on managing behavior rather than price. Instead of allowing market stress to redefine the exchange rate, authorities have emphasized tighter regulation of dollar transfers, improved documentation for trade finance and channeling demand through regulated banking systems. Another important reason Iraq's currency has remained stable is the way authorities prioritize system control over short-term market reaction, even when pressure intensifies. Market pressure in Iraq does not primarily come from capital, flight, or collapsing confidence, but from structural demand for US dollars. In a highly import-dependent economy, businesses, traders, and households all require dollars for goods, travel, and cross-border payments, which naturally increases demand during periods of uncertainty. This demand shows up in the parallel market, where rates rise above the official 300 IQD per dollar level. However, stability is maintained because policymakers have chosen not to let this demand dictate official pricing. Instead of adjusting the exchange rate to chase market sentiment, they address the channels through which dollars are accessed. From a factual standpoint, this means tightening compliance on international transfers, reviewing import documentation, and limiting informal dollar leakage. Investors interpret this as a sign of control rather than denial. When a country responds to pressure by improving oversight, instead of weakening its currency, it signals confidence in its underlying financial position. Another fact investors focus on is budget discipline. Iraq's multi-year fiscal planning continues to be calculated using the 1,300 rate, which anchors public spending and prevents sudden fiscal imbalances. A weaker official rate would immediately increase the local currency cost of imports, government contracts, and public wages, putting stress on both the budget and inflation. By keeping the rate unchanged, Authorities preserve predictability in government finances. This predictability matters because fiscal instability often forces monetary instability. Today's data shows that Iraq is trying to avoid that feedback loop. Stability at the exchange rate level supports stability at the budget level, and vice versa. For investors, this coordination between fiscal and monetary policy reduces overall risk. There is also a behavioral aspect visible in the data. Currency stability is reinforced when expectations are managed. Iraqi authorities have consistently avoided language that fuels speculation or promises rapid change. Instead, messaging has emphasized regulation, normalization, and gradual improvement. Markets respond to this restraint. When expectations are kept grounded, pressure does not escalate into panic. Investors understand that speculation thrives where messaging is unclear or inconsistent. The absence of dramatic policy statements, even during periods of higher parallel market pricing, suggests a deliberate effort to prevent expectation-driven volatility. A third factor explaining why Iraq's currency remains stable despite market pressure is the role of foreign reserves and external balance management. Iraq's financial system is heavily supported by oil exports, which continue to average more than 3 million barrels per day, providing steady U.S. dollar inflows to government accounts. These inflows are crucial because they replenish foreign currency reserves and give monetary authorities the capacity to meet legitimate dollar demand without changing the official exchange rate. As long as export revenues continue and reserves remain sufficient to cover imports and obligations, pressure in the parallel market does not automatically translate into policy instability. Investors watch this closely because a managed exchange rate is only credible when it is backed by real earning power, not short-term borrowing or emergency measures. Another important signal in the data is how Iraq avoids using the exchange rate as a shock absorber when external conditions change. In many commodity-dependent economies, currency value rises and falls directly with oil prices. Iraq's decision to keep the official rate anchored at 1,300 IQD per dollar even when oil prices fluctuate suggests an effort to separate short-term revenue cycles from monetary policy. This reduces the risk of pro-cyclical behavior, where falling oil prices force immediate devaluation and rising prices encourage excessive expansion. Investors generally view this restraint positively because it lowers volatility and improves predictability. A currency that moves less violently is easier to model and carries lower long-term risk. The data also reflects a focus on preserving reserve strength rather than exhausting it. Instead of aggressively flooding the market with dollars to close the gap between official and parallel rates, authorities appear willing to tolerate short-term spreads while protecting reserve buffers. This approach signals an understanding that credibility is lost faster when reserves are depleted than when market friction persists temporarily. For investors, this is a sign of maturity. A system that prioritizes reserve sustainability over cosmetic stability is more likely to endure pressure over time. Taken together, current data shows that Iraq's currency stability is not accidental. It is supported by export-backed dollar inflows, disciplined reserve use, and a deliberate choice to shield monetary policy from short-term commodity swings. These fundamentals explain why the dinar has remained stable, even as market pressure continues to surface. A fourth reason Iraq's currency remains stable is the emphasis on institutional coordination and consistent policy behavior rather than short-term reaction. Investors closely watch whether a country's central bank, finance ministry, and banking sector operate under a shared framework. In Iraq's case, current data shows that fiscal planning, banking regulation, and monetary policy continue to align around the 1,300 IQD per US dollar official rate. This coordination reduces internal contradictions that often destabilize currencies. When public sector wages, imports, and government contracts are calculated using the same exchange rate assumption, sudden currency moves become far less likely. Investors interpret this alignment as a sign that exchange rate stability is not an isolated policy choice, but part of a broader economic structure. Another signal comes from how authorities respond to pressure through process, not rhetoric. During periods when parallel market rates rise, Official communication has remained measured and consistent. There have been no abrupt announcements, no mixed signals, and no language suggesting panic or imminent change. In currency markets, messaging matters. Inconsistent communication often fuels speculation and accelerates pressure. The data shows that Iraq has avoided this trap by reinforcing the same policy stance repeatedly while focusing public messaging on regulation, compliance, and normalization. For investors, this consistency helps anchor expectations and reduces the risk of self-driven volatility. Banking sector behavior further reinforces stability. Data from regulatory actions indicates continued efforts to move dollar transactions into formal channels, improve documentation, and reduce reliance on cash-based exchanges. While these steps can slow transactions in the short term, they strengthen transparency and oversight. Investors generally view this phase as necessary for long-term currency resilience. A currency becomes more stable when informal flows are reduced, even if that transition creates temporary friction. Iraq's willingness to maintain these reforms despite market pressure suggests commitment rather than hesitation. Finally, investors assess whether currency policy appears institutionalized rather than personality-driven. Stability lasts longer when it is embedded in rules, procedures, and coordination rather than dependent on individual decisions. The persistence of the current exchange rate framework across periods of stress indicates movement toward institutional continuity. For investors, this matters greatly. It signals that Iraq's currency stability is supported by systems designed to endure pressure, not by temporary fixes. The final reason Iraq's currency remains stable despite market pressure lies in expectation management and risk prioritization. Currency systems often fail not because fundamentals collapse, but because expectations spiral out of control. Iraqi authorities appear focused on preventing that outcome by reinforcing realistic boundaries around what the exchange rate framework is designed to do. By maintaining the official rate at 400 IQD per US dollar, even when parallel market rates trade higher, policymakers signal that short-term sentiment will not override structural capacity. Investors interpret this as a sign of confidence. When a system lacks confidence, it adjusts prices quickly. When it has confidence, it manages behavior first. Another key insight from current data is how Iraq balances short-term friction against long-term stability. Allowing the official rate to weaken would immediately increase import costs, pressure household budgets, and raise inflation risks. By holding the rate steady, authorities reduce the likelihood of sudden price shocks that could undermine social and economic stability. Investors factor this heavily into risk assessment. Social instability often translates into political and financial instability, which then feeds back into currency weakness. Preventing that cycle is part of maintaining credibility. Current indicators also show that Iraq is preserving policy optionality. By not exhausting reserves or rushing into currency adjustments, authorities retain flexibility to respond if conditions change. This optionality is valuable. Investors prefer systems that keep multiple policy tools available rather than relying on one dramatic move. The ability to manage pressure through reserves, regulation, and coordination without redefining the exchange rate suggests that Iraq is maintaining room to maneuver. In the end, the data does not suggest the absence of pressure, but it does show control over it. Iraq's currency stability is the result of deliberate choices. A fixed official rate, oil-backed dollar inflows, disciplined reserve use, institutional coordination, and careful communication. For investors, this combination explains why the dinar has remained stable, even as market pressure persists. Stability here is not accidental. It is actively maintained.